BW Business World. Today we have with us Nandini Mansinghka. She's CEO of Mumbai Angels. Hi, ma'am. How are you?
Hi, Nitesh. So happy to be here.
In an interview to one of the media outlets, you said that you are planning to invest around 200 crore this fiscal year. So, what's the status of those plans? So, if you'd like to shed some light over there.
Yeah. So I think Nitesh, I think it's important for me to just give a little backdrop of what has happened with us because it's a new thing that's happened over the last 1 year or so. So of course, we have just got acquired by 361, which was last November. And that has actually given us this platform to be a part of this, one of the largest private wealth managers in the country. And apart from that, the other big change that we have done is that we have now started operating from a fund structure, which earlier we were only working as a platform. So if you look at us, say Feb March or so, we were a platform where we were connecting investors and startups, and everybody who was investing was coming on the cap table directly. It is just now that we have switched to a fund format, which means that we are a part of the angel fund structure, where every investor takes their own call on the investment like they were doing earlier. Only difference is that everybody comes through the fund, and there is the fund which invests into the format, into each startup. So that has actually given us a lot of leverage in the market. I'm not so sure if we will be doing the 200 crores, but I think we should be able to look at some numbers close to it. So I'll be able to come up with a better number, say January, February or so. What we are doing, what we have actually started doing very, very aggressively over the last 3-4 months, and this is a big change, because of the fund structure and how we are looking at it, is just the amount of, the work that is going behind a company before we put up. And that is one big shift that has happened, Nitesh, over the last 1 year. And you're going to start seeing changes on that, just because of the approach that we are taking in how we are being able to build this platform from here on.
So, Mumbai just also announced that they will be launching two funds of around 100 crore, of around 1,000 crore and 300 crore.
Yes, that is both are there. Those are the two funds.
Could you share some of the closure of those funds?
So see, it is the angel fund is already started investing. So all our investments have already started through the angel fund. So that is already launched. First closure is done, and we started seeing. So that is, when you look at the angel fund, the difference between how you look at that angel fund versus any other fund is there you are not actually asking people to remit money once they become an LP. What happens is that, say, like when I'm saying that, assuming we are going to deploy, say, 200 crores this year. Now, those 200 crores will be from the LPs who've already come on board. So the 1,000 crores that we would do, assuming the 1,000 crores I deployed over, say, a 3 or 4 year period, the drawdown will happen accordingly. So it's not a closure where the money comes to us and then we are deploying in a blind pool. So that is the angel fund. The cat one, we are still closing. So I think that will be, next 15-20 days or so, we should be able to bring that out immediately. And both these funds will operate in tandem. So how we are looking at doing this is that, we keep getting two type of subscribers on our platform. One who want to do deal by deal investing, and one who want to do, a blind pool. They want us to decide on their behalf. So the blind pool investing is the 300 crore number, which will basically look to invest in all the deals that the angel fund is closing. So these are the two strategies that are there for the two funds.
So you are very much active in early stage startups and early stage investment. So, what is the checklist before investing in an early stage startup? Let's suppose some like a young co-founder is watching or founder is watching, and then founder is watching our show. So, how they can like reach out to you, and how what are the checklists they should be focusing on before reaching out to you?
Yeah, so it's a very interesting question, Ritesh, and it has a long-winded answer. So I'll try and keep it very, very short. The first is, of course, anybody who's looking to invest. So they should immediately reach out to us at, you can do this via our social media handles. So we are very active on LinkedIn. You should just drop a message to us over there. You can also apply to us via our website. So you will go there and you can apply. You can write to us at pitch@mumbaiangels.com. Then, me and my colleagues are very active on LinkedIn. So you can reach out to us also. So it's either the brand web handles or us, and you write to us and we will get back to you. So that's how you reach out. We are looking at about 400 to 600 startups a month. So we are very, very actively looking for, smart founders to back. So if you are, are a founder and you're looking to raise money, we are very happy to have a conversation. Now, once the intent is there, now what is the checklist? What are the things that you need? Now, the first absolutely like critical thing is a pitch deck. And it's a very, I'm stating the obvious, but you'll be surprised by the number of founders who actually reach out to us who don't have the deck ready. And they are saying that, look, can we come and meet you? Can we come and explain our proposition? Unfortunately, the way the investing scenario is in the country, you will have to have a very strong deck. That's your first foot in the door to say, do I have a 10 slider, which basically explains, just the regular conversations on who are you, your team, what are you building, why do you think there is a market for it, what are your plans, what have you achieved till now, what are you looking to achieve over the next 18 to 24 months, how much money do you want to raise from us, what are you going to use that money for, more importantly, how long will that money last for you, and who do you potentially think will invest post our round. So we understand that we are early investors, and when we are putting money in, our money in almost all cases lasts for, anywhere between 12 to 24 months. So you as the founder need to be sure on saying, post this, who's going to invest and how much, right? So that is the other thing. And the other piece on this is on saying, how will I get my exit? So how many years do you think you will take to be able to, give us the return? How much return are you expecting? So these are very, very specific conversations that, a founder should actually think about before approaching us or any other investor. And how you actually talk in that first 15-20 minutes with these data points. It's not just about impressing the investor, it's about these data points, which actually decides whether you're going through the next round or not. Right? So these are some very obvious and basic things. Then, of course, there are next couple of things that we look at as investors is, at Mumbai Angels, we are not looking at just an idea stage company. So that's very clear that if you are, say, a D2C brand or a B2B brand or a SaaS or a platform, anything that actually requires you to demonstrate that you have the first few investors with you, we would require you to have that demonstrated. So couple of investors. So if it's a B2B, even if you have a single investor, we are good. But you need to have that investor. If you're doing a D2C brand, at least a minimum of 10 lakhs per month type of revenue you need to bring into us. We will only look at pre-revenue companies, which are actually tech product companies. What that means is you could be in anything. So, we've looked at med tech, defense tech, space tech, just general social media, anything which is a product, and you have built the product and It is either a patent pending or patent applied for, and or you need money to actually do the first few testings, right? We will come in at that stage if it is a product. If it's a tech product, it's a pre-revenue. If it's a platform or business or anything that requires customers, we will require you to come up with the first few customers.
As far as early stage startups are concerned, when I talk to investors, they say that there is not much of funding winter in the early stage startups as compared to the later stage startups. So what's your take on this? Like, what makes early stage startups a bit unique than the later stage startup from a investor's point of view?
I think the first thing is that, because most of when we're talking of the early stage investing, if you see, most of the times they are actually being funded by individuals or in accelerators, incubators, or funds which are focused on this very early stage. All these three type of investors actually are a very long-term outlook investors. So even before, say, the funding winter started, when an investor comes at this stage, they know it's a 3 to 5 year wait. So they are anyway not looking at, a quick 2 year turnaround, etc., which actually starts happening the more mature a company becomes, the timeline for which the investor is willing to wait before they get their exit starts reducing. At the earliest stages, what happens is that because the view is anyway long term, the investor is willing to bet the good startups irrespective of what are the market situations. Now, I will actually put a caveat here that while there is no funding winter, what has happened, and it's a good thing that has happened, is that now suddenly there is a lot more conversation around the strength of the business. Revenue potential, what is the strength of the team, that specific team that is building out to be able to deliver, what is their execution plan, how strong are they on operations, are they burning money, or do they know how to survive in a tough time? So these conversations were earlier not happening because we were flush with money. So it was almost like burn your way through the next round of funding. Now it is not happening, and which is a very, very good thing. Even at our stage, we have started asking these questions a lot more. Valuations have become a lot more discussion based, which I actually thought was something that I wasn't very comfortable, say 2-3 years back. Too much of money chasing just a few founders. Those things have become very good, and that's why there is no funding winter. What I am, however, seeing is that our own portfolio companies which have raised money with us, and which have, say, been in the market, who've raised money with us, say 2 years back, 3 years back, those same companies are finding it a little more difficult to raise money in the next rounds. So the funding winter for us is not apparent at the time when we are investing. It is apparent when the same companies have become bigger and they're looking to raise next round of money.
We have also noticed that startups have shifted away from boosting metrics like GMV or user base or maybe revenue. The new focal point is right now is PAT and adjusted EBITDA. And how these dynamics are changing, and what are the underlying factors behind it? Like, is there any push from the end of investors to be profitable as soon as possible in the mid of this funding crunch?
See, I think there is only one metric that really matters. If you take all the jazz and all the fluff and dressing off, it's runway. Basically, how much money do you have in your bank, and how long will you be able to run before the next guy comes in with the money? If you're not being able to manage that, you could be the greatest business idea across the globe, but you will not be able to survive because you will run out of cash before the next round of funding comes in. That is why a lot of conversation now, when you hear on conversations on PAT, on path to profitability, cash burn reduction, how are you actually becoming it? All of this are just targeted towards runway management. If you, and what, that's the point that I'm trying to make, that in our portfolio companies also, that is the only single metric that we look at very closely once we have invested.
Valuation markdown from investors in recent months. So there are many startups that have seen a valuation markdown from investors, particularly from overseas investors. So what are the key underlying factors behind it? Is it going to affect the next round of funding of those startups particularly?
I actually think it's a very good thing, you know, Videsh. It's the same thing that I was mentioning. Look, what is a valuation markdown? It is basically some person, some investor was willing to pay a certain amount, 100 rupees, for your startup and its potential 2 years back. And now, when you're out there in the market trying to raise money, a different set of investors are saying, no, your company is not worth 100, it is actually worth 90 or 80. Now, the question is not on whether it is a markdown, but was 100 the right valuation or not? So it is always a question of saying that if you have raised money in a uptight market where money was easy to get, investors were not pushing down on valuation too much,
Couple of years
and
back.
now so then you're overvalued, right? There is exuberance. So this is, you know, what you would call exuberance valuation. Now, exuberance valuation, now you are actually coming to realistic valuations. Now, if a realistic valuation means a markdown, so be it. Like I just, I actually look at it, and my view is that the only company that actually means anything in the long run is with the one which survives.
Right.
You could have and we have so many instances already where saying your valuations could be in hundreds of millions of dollars. But if after 2 years you're back to zero or you're shutting down, what was actually created? You've actually just had a very good high and you've had good PR and you've had conversation, but finally you have not created value for yourself as a founder or for your investors. So if markdown is the solution, you go for that solution. My other view on this is, for founders in this scenario, and I'm talking of later stage when we think, if there is money on the table, take it. That, like I'm saying, you have to survive, and you have to survive a certain time where what happens is that right now, just because in the later stages there is a valuation pressure and there is a funding winter, you could be a very good company which could have got an X valuation, say 2 years back, but reality is today you're not going to get that valuation. So are you going to walk away from that money and actually shut down, or are you going to take that money? So we
have also noticed that in mid of this valuation markdown funding crunch, startups such as a few giants in food deliveries and all are shutting down their non-profitable verticals. Or what is that? What is your take behind it? Like,
it's the same thing, Nitish. It's runway management.
All right.
It's a very simple math. Every founder has to look at their profit and loss statement very hard at the end of every month and say, how much money do I have in the bank? How much do I spend every month? And how much do I make every month? And these three numbers will tell you how long will your business survive if you're not being able to raise more money. So there are only two places, right? So basically, if this is your gap, you want to, the only way to increase the gap is either increase revenue or reduce expenses. Then there is no third. The third is to bring in money infusion. So if money infusion is not happening, you have to find a way to, this is like the industry parlance is widening the jaw. So you have to widen the jaw by increasing revenues and reducing costs. That's it. That's what's happening.
In an attempt to cost cut and restructuring, startups are also laying off. So what is a major reason behind it? Like, is it the overestimation of the market size or something sort of that in the COVID era, or what?
I think it's a mix of both. I actually think that on an overall basis, I think in our estimations over the last say 2 or 3 years, we have actually overestimated the pace at which the Indian consumer market is growing. So, if you actually added up all the startups, uh, estimates of how much money they're going to earn or how much they're going to sell, all of it together is going to be several times higher than what the overall market size is. So that is what is, so you've done overestimation of the market. Second is, I also think that a lot of companies have actually raised more money than they needed in the peak of the funding, the funding peak. And then the investors have pressurized them to grow at a faster pace than what is sustainable. So when you then, at that point, you actually try and do too many, things, which the minute you have to now start conserving cash and start saying, okay, let's, like I said, runway management, is when you actually say, oh, these verticals or these deviations are not really core to my business. I have to come back to my core, rebuild it, make sure that I'm profitable, then become a company that is being able to raise the next round of money and grow from here. I think it's a good correction zone. While it will create pain, at the later stages for, of course, anybody who's losing their job or a founder who's, losing share in his company because of markdown. Investors are losing money. There are, of course, failures that are happening. I think it's a good thing because it will get us to a more, sustainable growth. I just want to add a point here on corporate governance. So I am actually, if there was one thing that I'm worried about, it's the corporate governance and the startup ecosystem in India right now. I think the founders and the investors together need to do a lot more together to bring the corporate governance of startups to a much different level than it is today.
Again, back to Mumbai Angels. What are your plans regarding exit this fiscal year?
So look, at any given point of time, about 10 to 15% of our companies are either in conversations of next round of funding or exits. And we are seeing that as a continuous churn. So I see the same trend happening in the next this thing. So unfortunately, at the stage where we are not being able to drive the exits, because we are too early into the entire value chain. And what happens is this for us, more often it is the next round of funding, for which basically shows an uptick on our valuation. And then at that time, when there is an uptick on valuation, at times there is a secondary offering that some of our investors take. So I see that the same number, 10 to 15% of our portfolio, which means about say 15 to 20 companies.
All right. So while exiting a startup, what are the checklists you see? Like, what are the returns you aim for as far as early stage startups are concerned?
See, unfortunately, it's not in our hands. It is a market-driven number, and it is a number that is actually driven by the next round of investor who's coming in. If you are asking me on my historical numbers, we have a 37% IRR across all our portfolio companies. And I actually think that somebody who actually invests in startups should look at it as a portfolio. And I've said this over and over again. They should look at it as a portfolio approach and not look at saying, can I have 5 companies which will give me 100x? Because you will never be able to find those 5 companies. You will have to invest in 30, 40 companies, of which 5 will give you that, 100x. And overall, it will give you anywhere between 30 to 35%. So that is the way that you have to approach it. And I am also of the view that, as and when secondary offerings come, whenever there is a primary, the investor should actually take their independent call on saying, do I want to take some of my money out right now? Do I want to take just the principal out? or do I want to remain invested? Like one of the classic strategies that prolific angel investors apply is to not exit till it is absolutely mandatory. Like sometimes a new investor will come in and say, I will not buy until unless everybody else sells, right? If you have an option to stay invested, we have seen that you will make more money if you continue to remain invested over a longer period of time. However, if you are not wanting to stay that invested in a certain company, or you want to maybe balance your risk out in the asset class, you can actually do a part exit and keep the money there.
What are the untouched sectors you would like to invest in this fiscal year?
Untouched, so I don't know, but I'm actually looking to invest in some very good blockchain opportunities. We are very gung-ho here, but I'm unfortunately not seeing too many good companies that are coming our way in that. Web3, I don't really understand what that term as an industry is. I would try to look at it, the subcomponents of it, which some of, say, are you in the creative piece? Are you in the NFT space, blockchain, various things. We haven't unfortunately seen too many good companies coming out of India looking for that. On the other side, we are very, gung-ho on clean tech. We've seen green tech coming up. I'm also seeing agri-tech come up. I think very soon you will start seeing stuff in blue tech, which is sea-based investments that will happen. Space defense are anyway our perennial favorites. SaaS is SaaS across different these things. We are also seeing some very interesting stuff coming up in healthcare, medical, those areas. These are the ones that we would like to, and we are continuously looking at these. So if you look at our offerings on our platform at any given point of time, we have about, say, 10 or 15 companies, and there will be a mix across all these industries.